Yeah, exactly. I heard somebody say if it's not an F yes, then it's a no. And so
Oh, I like
I've tried
that.
to abide by that with my lending. So it's like I want to poke as many holes as possible in the deal and the borrower. And if I find any holes, then I'll dig a little bit deeper and find out what's going on. But ultimately, if it's not an F yes, then it's a no.
What's going on, everybody? I'm so excited today. Hey, y'all, I have Casey Hilgers. She's amazing. I met her at Private Money Mastermind here in, I think it was Georgia. I
Yeah,
remember it. Yeah, you came to the Georgia event.
yeah.
So, yeah, we met each other at the Private Money Mastermind with Abraham Gray and Alexis Morgan, and we learned a lot about private money lending. And we're like, oh my God, this is going to be so cool. Have Casey in here so we can keep talking about private money lending, right? Casey, but thank you for being here. Thank you for taking time out of your day and just having this conversation about private money lending and a little bit about yourself.
Yeah, of course. I'm happy to be here. Thanks for having me on.
Awesome. Super excited. So, Casey, tell us a little bit about you. I was trying to remember where you were originally from because when we met at the Private Money Mastermind, we talked a little bit, we networked a little. So, you're based out of, you currently live in California, right?
Yes, I'm in the Bay Area, so just south of San Francisco, but from the Phoenix area.
Ah, that is so awesome. So how is I know California is definitely one of those markets where people don't want to invest, others do want to invest.
Yeah. I'm on the side of no. So,
No.
yeah, I don't invest in California. I have properties, but none of them are in California. I don't lend in California. I stay away from it.
Yeah, and I mean there's good reason, right? The
Yeah.
the the regulations around lending in California are super, I don't know, weird or
Yeah.
not favorable to a lender or a landlord.
Yeah, exactly. And like the price of housing and if you are a landlord here, it's again not very favorable for you. So it just doesn't make sense.
Yeah.
Yeah.
Well, thanks again, for taking time. And I know there's a huge time difference. We were playing tag. We're like, hey, which time zone works best?
Yeah.
What time works? And so I'm so glad we were able to connect. And, so tell us a little bit, Casey, how did you get into like the real estate game? Were you looking to become like a landlord, like build up a huge rental portfolio? Or did you get into the wholesaling or you thought about doing fix and flipping? How did Casey's journey start when it came to real estate?
Yeah, so I started, I have a full-time W-2, still have a full-time W-2. And so I started because I knew that my W-2 was kind of I couldn't have, it wasn't like a good source of income in terms of, it was a good source of income, but if I ever got let go or anything of that
Mm,
nature, it was a single point of failure, right? And so I was like, well, I need an additional source of income to hopefully eventually supplement or at least match my W-2.
mm.
And so I got started in the world of real estate by listening to Bigger Pockets, reading the books, kind of similar to everybody else's journey that I hear. And so I started by buying a like turnkey single family house in 2020. The interest rate on that is still 4%. It's
Wow.
amazing. Yeah. So super easy house to buy for the first one. And then, like most people, I did the math. It was cash flowing $300 a month. And I was like, well, if I ever want to become W-2 optional, that's a lot of houses. So then I started to hear about Airbnbs and short-term rentals. So um, I believe it was in 2021 or 2022, I bought two short-term rentals within a month of each
Wow.
other, which would not recommend that. That was incredibly stressful. I've never been more stressed in my life. And then I bought another short-term rental in 2023. And so I was all in on this like Airbnb game because the returns were pretty good, but it started to take a toll on
Mm,
it was my husband and I who were managing them, and it started to take a toll in terms of like the amount of time that we were putting in. We didn't have enough time for ourselves or like prioritizing our family, and so it just became a lot to manage those and a W-2. So then I started looking at for different ways to make a return within the world of real estate that
mm.
returns that were competitive with the Airbnb space, but without managing guests. And so,
Mm,
I found Pace Morby, I joined the Subto and the Gator communities, and I found lending. And so it's like, this is amazing. Like, I have all these like I work at Amazon, so I had all these Amazon stocks. And I'm like, I'm a little over leveraged in one particular stock. And so I started lending about mid last year, and lots of lessons learned since then. And I feel like right now I've like found where I like to lend and what I like to lend, who I like to lend to as well. I think is very
yeah.
important. So I've lessons learned. I wouldn't do again, but it's all part of the journey, right? So
Yeah, we'll definitely dive into some of those lessons learned, right? And how you pivoted into the lending. But let me take you back a little bit because you touched a lot, some amazing information as far as everybody's journey, right? How we all start and how everybody sees like that rental portfolio, or hey, let me acquire some properties, right? Because of the appreciation and how these
yes.
properties are going to value over time, right? And it's going to be a great retirement opportunity. But you mentioned two different things, right? Like, hey, how can I get cash now, right? Like that
Mhm.
active income type of thing to potentially, replace my W-2, or if not, just have that extra income, right? That
Yeah.
cash flow. And you saw that $300 a month wasn't going to do it, and you needed a whole lot,
Yeah.
and you pivot into the Airbnb space. For those that may not know about Airbnb and the short-term rental space, tell us a little bit more about what is that? You said it takes up a lot of time and energy. Let's
Yeah.
let's open that box a little bit more and tell us what does that mean? Like why does it take up so much time?
Yeah. So I think I kind of bucket it into two main phases, right? There's like the property acquisition phase where you're looking for properties, perhaps you find one that you like, you get it under contract. And then the second phase of once it's under contract, well, probably three phases. It's, getting that Airbnb set up and ready for guests. And then it's just kind of more of the sustaining side of like managing the
Mm,
guests. And I think, looking for the properties, underwriting them was similar to getting a long-term rental in terms of the amount of effort. The amount of time and energy it took to actually set up those properties was significant.
mm,
I was working my W-2, and I remember the first like week of the first property that we bought, it was, I was scrambling to get the Wi-Fi set up so I could at least look like I was online. Once I was online with that, it was like working from, 9 a.m. to 3 p.m. And then from 3 p.m. to like 1 a.m., just setting up furniture and like
mm,
the walls and making sure it looked good and it looked nice, and making sure that those like very quintessential like guest moments were there within
hmm.
the property, so it's actually something somebody would want to enjoy and stay. And I remember we set that property up in 2 weeks, so it was a lot of
Wow.
work. And then from there, I flew from West Virginia, where the first property was, to set up our next property because we bought them back to back. And I was doing the same thing again. So it was probably about a month and a half of just like, 4 p.m. till midnight, 1 a.m., just setting up furniture and really pushing quite hard. But once those properties were up and kind of this like sustaining piece of it, it's managing guests, it's managing our
Mm.
cleaner, it's finding cleaners, it's managing the cleaners, making sure that they um,
Reliable, right?
very,
Reliable.
yeah, reliable in communication. I think a big lesson learned from like the Airbnb space is that, what I think is good communication, Edgar, we might think good communication is very different things, right? And
Right.
so finding a cleaner where communication is key, like they're your boots on the ground. If the batteries need changed in the locks, like they're the ones doing it. So you really do need them to communicate as much as possible while they're on site. It's like if something goes wrong, one of the properties is in Tucson, Arizona, which gets quite hot. So we've had our
Yeah.
AC go out a few times, just because it's so dang hot. And we need to call and get somebody to the property that same day. So we're paying a premium, obviously, to get somebody the same day, which is totally fine. But it's like being able to respond quick enough, and you're always kind of near your phone, hoping that like
Mm,
I love to go outside and I love to go for hikes. I love camping. And it's like, well, if a guest needs something, like, are we going to be
right.
able to respond in time? and you're kind of always on defense in that sense. And so
Mm,
after a while, it's quite taxing.
yeah, yeah, definitely. It's not giving you that time freedom, right? Because
Exactly,
now
which is the whole
you're
point of
locked into your phone as an on-call person.
exactly. So we have the W-2, and then we have the Airbnbs, which is kind of another, job. And we put systems and processes in place, and there's
Sure,
tools that can help. And we have a VA that helps answer guest comms during, 8 a.m. to 5 p.m. And that helps significantly, but it's still in the back of your mind of, if something goes wrong, it's on me. If there's a
right.
guest that needs help, that's me, right? And so as much as people online say that you can automate it's only to a certain degree.
Right. Well,
Yeah.
that was, the other thing I took away that, the risk you took as well, right? Because you live in California and you took that risk to invest outside of California, right? So setting up these properties like remotely, right? Spending 2 weeks or, and then that takes a lot of risk, right? Like
Yeah.
managing people that you can't just like potentially walk them or see them once in a weekend or whatnot, right? Like building those relationships outside of your state, that was
Yeah, it was challenging. Thankfully, I knew other, well, not direct friends, but I had joined
hmm
another community where people had been doing this. And so I think having that, when you surround yourself with people who are doing the things that you want to do and make it seem
right.
super easy, then it just makes it so much more digestible and so much more, you believe that you can do it. Like, if they can do it, then why not me, right?
Yeah.
So I think that helps a lot, is like when investing out of state or lending or anything of the nature, right? It's like, okay, if other people do it, then I could do it too.
Yeah, no, that's such a good point, right? That community aspect, being able to support each other is so important. Um, so you were sound like you were having great returns, right, in Airbnb, and then something triggered, right? You started looking at other possibilities, at other avenues to make money, and you went into the lending space.
Yeah.
So, when you heard about lending, what did that sound like to you at the beginning, right? We did, you mentioned about some important lessons. So let's just start from the beginning. Like, what did that sound like, when you heard, hey, lend your money, like, and then boy Pace, right, shares his story about Gator lending.
Yeah.
It makes it look too easy, right? But
Too easy.
when you joined Gator and you were like, hey, I'm going to start taking my baby steps, what did that look like?
Yeah. So well, actually, I joined Subto first, and I lent on my first deal before I had joined Gator, before I went through the
Oh,
Gator training.
okay.
So again, lesson learned.
Lesson
Um,
learned.
Yeah. So the first time that I saw people posting in the Sub2 community of different lending deals of, hey, here's the address, here's the return, here's the term. I was like, oh, this is crazy. Like, this is not real, right? And then I started seeing it post more and more. And I said, well, I should learn a little bit more about this. So I set up a meeting with a few folks who had done it before.
Mm,
And so I felt comfortable enough to get started based off of those conversations without having taken the underwriting training to the degree that I should have, right?
mm,
And so my first deal was a second position loan. And so, it went significantly past due. And
mm.
so, and I'm still kind of dealing with the ramifications of that, to be quite honest with you. But I won't be doing second position again. And like
Yeah.
after that PML mastermind that we went to in Atlanta, I learned so much. And I did my first deal in Gator, or sorry, when I was in Sub2, probably mid of last year. And I thought, well, this is amazing.
Mm.
And so then I joined Gator, went through all the training, went to the PML mastermind in Atlanta with Abraham and Alexis, learned even more than I thought was possible. And so it's been a really fun journey of like learning this whole new industry.
Yeah. And I wanted to go back to when you mentioned about the post, right, in our Facebook group where people pitch their own deals, right? And
Yeah.
they say, hey, we need capital for XYZ project. You get X amount of returns. So, if you could take us back in that portal and look through those Facebook posts, right? And I know we're limited, right, with the knowledge when we start joining these communities and all this stuff, right, that gets thrown at us with these amazing returns potentially. But if you were to talk to Casey from back then, right, and you said you had actually took the initiative at least to have conversations with people that were lending,
Yeah.
what type of questions probably could you have asked differently? Or did you like, I'm curious, right? How did that conversation go with those people?
Yeah. So when I started having those conversations, I was more so looking at who they were as a person and kind of like trying to build a relationship from that
Mm,
standpoint. Not necessarily understanding like the deal underwriting and the math behind it. And if
mm,
I could go back, I would probably look to understand the math behind the deal a little bit more before I lent that money, right? Because I had the paperwork in place. I felt like I had that relationship established. But, as Pace says, like you, just because you meet somebody online doesn't mean you actually know them, right?
yeah,
And so I think that was really big for me is I wish I would have known the math behind it because what I'm learned is the math doesn't lie, right? Like it's
yeah,
always real estate is a numbers game, right? And
right.
so I think that probably would have been, what I would have changed going forward is figure out how that math works. Obviously get the paperwork in place, which I did.
Absolutely.
But like the relationship to me comes, well, relationships are important, but don't rely just on that when lending money, right?
Yeah, really understanding that risk tolerance, right? I
Yeah.
like to say, what is your risk tolerance as a lender or just as an investor in general, right? When you're coming into an investment opportunity, what is really that risk tolerance? Is it something that, you could potentially lose, or is it something that, hey, no, I mean, I rather make safe returns but calculated returns, right? And that's where that risk factor is so important. So, and numbers don't lie, what you said, right? I
Yeah.
mean,
Yeah, I think that's a really good point. I think knowing your risk tolerance ahead of time before you see these like flashy deals is so important because then you could easily say, yes, this is in my lend box, or no, it's not, and here's why. And it's clear and dry versus like, ooh, the returns look so good, or oh, like I know this person, right? Like it makes it a black and white decision when it comes to time to lend your money.
yeah,
Yeah.
that's such a, yeah, so good right there. Because, you mentioned, right, the borrowers, Pace always says, hey, make sure you bet the deal, the jockey, right? And the horse, right? The horse is the deal and the jockey is the borrower. So
Yeah.
both of them have to be vetted.
Yeah.
And to your numbers don't lie, but at the same time, people that are in this business and are gonna like succeed long term, they need to do right as well, right?
Exactly.
So, and sometimes it's interesting, right? How some people manage to just kind of hide under the mistakes they make and not own them, which
Yeah,
is like,
exactly. And we all make mistakes, and that's okay. It's just how do you react to those mistakes? And so, like that first deal that I did, the borrower had done a slew of deals beforehand, and they had been paid back to their lenders. I vetted them, like asking what other folks that they had lent their money to, like, did they get paid back? Like
mm,
that was all that checked out from a borrower standpoint. It was the math of the deal that didn't check out. And so when it was time to, a slew of things that went wrong, but when it was time to refi or, sell the property, the math wasn't mathing. So,
yeah.
yeah.
So let's talk, we mentioned about the risk factor, right? Risk tolerance and how you got into lending.
Yeah.
And let's talk a little bit about numbers, right? We mentioned risk factor, which is super important. We keep saying numbers, numbers, numbers.
Yeah.
We mentioned second lien position. For those that do not understand lien positions, definitely, we'll put some notes in the description, right, and give you a little bit more breakdown of what first, second lien position, third, fourth, fifth, maybe.
Yeah.
But yeah, but we'll put some info in the descriptions down there and give you, some free value there about what all those lien position means. But when we talk about underwriting and numbers, walk us through, right? Because this was a fix and flip project, correct?
It was, yeah, exactly.
Yeah. So, if we were just to give some examples, just, I guess, just some numbers, right? So if you lend $100,000, right, and the hard money lender comes in with $90,000,
Mhm.
right? So there's a $10,000 gap there, right?
Yeah.
So if Casey or myself has second lien holders,
Mhm.
second lien position, right? We come in and we say, yeah, it's fine. I'll lend you $10,000.
Yeah.
There's not enough cushion in there, right?
Nope.
So
There's definitely not. Definitely not. So the way
for
I've been
mistakes, right?
exactly. And so the way that I've been underwriting my deals now, and I only, lend first position now. So I am in that, I guess the hard money lender, or I guess for
Mm-hmm.
other something maybe that's a little bit more easier to digest is, your mortgage on your home. Like that's the position that we're in first position, right?
Absolutely.
It's, I only lend 80% up to 80% of as is value, not
Mm,
after repair value, right? Just in case that borrower does, worst case scenario happens. They pass away, they get hit by a car, like they run away with your money, whatever it is, like it's
absolutely.
protected by only lending 80% of what its current state is in its dismay and need of repair. So that's how I've
Yeah,
been underwriting now. And it's been significantly more, it's safer from a numbers perspective.
absolutely.
And if somebody does want to get a second position behind me, that's totally fine. But um, I'm only comfortable lending it to that point at this point, and so that's my lend box. And if somebody's not comfortable with that, then that's okay.
Yeah,
No
that's
big deal.
okay.
Yeah.
Yeah, so, talking about numbers again, you mentioned 80% of the as is value, right?
Mhm.
Tell us, why is that important for a lender, right? To have that buffer in right in the purchase price, right? So let's say that somebody locks up a property again, $100,000,
Mhm.
and the as is value, or 100, yeah, they lock it up at $100,000. That
Mhm.
is the as is value. So you would only lend $80,000, right?
That's exactly it.
So why do you create that cushion to, help us understand, why is that important for as a lender?
Yeah, that's a good question. So it's a few things, right? It's the scenario in which the borrower walks away from the property. So we're only lending what it's currently worth. And usually, as you know, these properties are in need of some sort of rehab, and that's how we get our money back, right? So in lending in its 80% of its current state, we know that if the borrower does walk away, then we're covered, because we're only lending what it's currently worth, not what it's worth in a month from now or 6 months from now.
Mm,
The 80% also buffers for, the additional fees that it costs to have the loan, to have somebody come out and inspect it, if any sort of legal fees that happen due to foreclosure, or all of the sort of like expenses that come about, then you're protecting that 20% by only lending the 80, because things will always come up, right?
yeah, absolutely. And it's so important, right, to have that buffer as a lender, right? Because when you want to make your money and potentially some, right? I mean,
Yeah,
yeah,
exactly.
so you want to build in a little bit of cushion. And then you mentioned fees, and all states have different fees, different foreclosure laws, right? That could
Yeah.
potentially drag on a potential auction for you to, sell it quickly. So
Mhm.
all those fees add up, right? So it is important to have that cushion in there for you to be able to recoup your money. Best case scenario is you recoup your money, and well, actually, but that, yeah, best case would be you recoup all your money plus some.
Yeah, exactly, exactly.
Yeah, so pretty awesome how you pivoted into the first position, right? Super secure, super safe opportunities. And I did mention states. So are you specific lending in a few states, or tell us a little bit about what states do you guys lend
Yeah,
in?
that's a good question. So I don't have I don't have states that I lend in. I have states that I won't lend in. I'll say that. So states like California being one of them, New York is another one. States where their foreclosure process, right, is, I would say, 12 plus months. Like
Right.
that's a no-go for me. Where I've really focused on lately is lending with one particular borrower that I
Mm,
really do like working with. They lend in, or sorry, they buy, and I lend in, Indianapolis and Detroit. And so I really
nice.
like their style of communication, how they underwrite deals. We're very much aligned on that front. And, it's been a really great process thus far. And so I've really focused on lending my money with them.
Yeah. Well, those are great markets, it's definitely, great rental properties, right? Good markets for rental. So that means that when they refinance it, they have that higher probability that's going to refinance for that amount or some, right?
Yeah, exactly. And I think another thing to note is like the exit strategy. With that first
Mm,
property that I lent on, it was a fix and flip. So it was very market dependent on when it sold. So as you know, the market the past, 6+ months, because of everything that's going on,
yeah,
it's been very, it is very drastically from where we were a few months ago. And probably from where we will be from a few months from now. Whereas if you're lending, if for, a refi, somebody who's keeping that property within their portfolio, then it's not as dependent on what's happening in the market. It's more so dependent on the rents that you can charge, which are pretty stable, right? So
yeah,
it's been a it's definitely helped me sleep at night knowing that I'll get my money back because it's less variable, it's less dependent on what's going on within the economy.
yeah. No, that's true, right? Market rents are, if not going up,
Yeah.
so it definitely helps at the time of refinance. For those that don't know how investors refinance is using through a DSCR loan product,
Mhm.
and it's market rent alone, right? So they use market rent as their underwriting tool, and they could potentially cash out refi 75, some do 80%. I saw the other day that somebody was doing 85% cash
Oh,
out refis, which is like, wow.
that's amazing.
Yeah. So, those are great tools for investors that, like Casey mentioned, if they wanted to buy and hold and keep it as a long-term rental or maybe other strategy, right? Section 8 or whatever
Yeah.
their strategy is, that they'll be able to refi out and pay out the private money lenders. So pretty awesome.
Yeah.
And you mentioned exit strategy, and that's so important, right? Because we come from the space where our mentor is Pace Morby, and he's all about creative finance.
Yeah.
So there are so many other strategies that where people are going to need capital, right? So
Mhm.
understanding the exit strategy is so important, right? Understanding the deal. Fix and flips are one thing, but once you start lending in creative deals like uh, uh, maybe a subject to, or maybe a wrap deal, or
Yeah. Or a
all these
piece
other
of
deals,
living. Yeah. Yeah.
yeah, they, as a lender, you definitely, your spidey senses need to go up and say, I need to ask more questions.
Yeah, 100%. I feel like if somebody can't explain it to me, the exit strategy in like one or two sentences, then I'm not lending. It's just if it's too complicated, then I don't it's not worth my money or my time.
Yeah, yeah. So I love that, right? So keep it simple. So, as a lender, if they don't, keep it simple for you, spidey senses go up. Be like,
Yeah.
what's going on here?
Exactly. And if like I feel like another red flag that I've learned is like if the information prepared for you isn't in a well organized, thoughtful manner, then the likelihood of the borrower giving you clear updates, giving you any sort of information in a thoughtful, clear manner is it's quite low, right? Like so
Yeah,
how it's presented at the beginning is probably how it'll be throughout the process, the loan of the lifetime of the loan. So you got to keep that in mind too.
yeah. That's good. Yeah, excellent point right there. You mentioned communication earlier, and that falls right into that, right? So in these projects, you need to have somebody that has an amazing communication. And I've always said it like, hey, I sent you an email. Well, that's not, I rather you over communicate with me
Yeah.
than just
Yes. I'd
send,
rather
I
you
send you an
over
email.
communicate than under communicate. And let's
That's it.
define what like good communication looks like at least once a month updates, right? So
Yeah. Yeah, I love that. I'm a big fan about over communicating. It's
yeah.
like, yeah, no. Unless you tell me, hey, this is too much.
Exactly. Like, I'll tell you when it's too much, but odds are it's probably not. Yeah.
So, we talked about one of a few red flags already. For those that didn't catch it, right? Hey, lean positions, red flag, right?
Yeah.
Numbers, making sure you understand numbers, right? Understanding that, super important. And then exit strategy, right? And simplicity.
Yeah.
So, for those, that are keeping track or taking notes, please, keep track of these four things that we've talking about. We've talked a lot about more, but those are the four things that come to my mind right now.
Yeah.
But what would be another red flag that you think lenders should be wary about from, if somebody gets pitched the deal, um, that you would want to say, hey, keep an eye out for this.
Yeah, I think if it's somebody new that we're working with, like we've never done business with them before, I think a red flag to me would be, when is that close of escrow date or when is that date needed, when they need the funding by. If it's, 24, 48 hours, 3 days, to me, that's a red flag. Um,
Mm,
because as a lender, while I can move at that speed, starting off our relationship, I don't want to be rushed, right? I
yeah.
want to make sure I have all my ducks in a row and I vetted you and the deal properly before I say, hey, I'm ready to fund. So, if they come to me and ask and they have all of the information laid out in a beautiful structured way and like all of their, FICO score, their liquidity, all of that documented, sure, we can have that conversation to fund very quickly. And that changes. But if it's a haphazard proposal and they want funding within the next 24, 48 hours, that is a red flag for me.
Mm,
I don't think it's good. I don't think it's a good business decision to be making funding deals that quickly,
yeah.
especially if I don't know somebody.
Yeah, I agree. I mean, that feeling sense of rush, yeah.
Nobody likes
Everybody, nobody likes that. And not only that, right? You have your own SOP, right?
that.
So it doesn't help you to cut any of those processes that you put in place, right? To try to accommodate somebody that could potentially, be a bad deal. So
Exactly.
the reason, right? When you get into this lending space, you do have to create those SOPs that where if you mentioned right what some of your SOPs, hey, what is that FICO score, right? What's your liquidity like, right? You
Yeah.
mentioned some of the things you look for from a borrower, and if all of those things cross in line, right? Hey, and you have a reputation, right? And you've done deals, but you need capital now. It's possible, but at least you're not cutting any of those SOPs, right? You're not taking any of those things or creating shortcuts for this person because they need the money like in 24 hours or 48 hours.
Exactly. It's taken me
What
years to build up the capital that I have to lend out, and so I'm not gonna lend it out in a second, right? Just because somebody
exactly?
asked, right? It's not fair to them and nor to me, right? So I
Absolutely.
completely agree.
Yeah. So yeah, for those, that's another important when somebody comes in and they're rushing a situation. Nope. Hey, step back. You're not the catch the next one, when you're fishing, just wait for the next fish, let it go.
Yeah, exactly. I heard somebody say, "If it's not an F yes, then it's a no." And so
Oh, I like that.
I've tried to abide by that with my lending. So it's like I want to poke as many holes as possible in the deal and the borrower. And if I find any holes, then I'll dig a little bit deeper and find out what's going on. But ultimately, if it's not an F yes, then it's a no.
Absolutely. I love that.
Yeah. Yeah.
So, we talked a lot about, several red flags that you can look for as a lender, right? But one thing I do want to highlight, right? The positive side, right? When
Yeah.
things do go smoothly, we mentioned about as an investor from the buy and hold, you did Airbnbs, right? All the
Yeah.
stress, managing and then setting up properties. As a private money lender, what are some of the positives though to that, right?
Oh, I can go on.
Once you do your underwriting, right, and the deal makes sense, and do you structure monthly returns? Do you structure, hey, big sum payment at the end? Let's talk a little bit about those positive things that come as being a private money lender.
Yeah, I mean, I feel like there's so many positives. So, I feel like, for Airbnbs or short-term rentals, the targeted returns were 20% cash on cash or 20% return on your money for, each year. And I would say, we've been hitting the 15 to 20% mark, but with a lot of time involved. So if you think about my cost per hour, it's actually what I make is quite low because I'm putting so much time into these
Mm,
Airbnbs. Now, if I look at the lending side of things, I'm making 15% flat returns for 6 months. And so, I underwrite the deal. That probably takes me 2 to 3 hours. And then, I'm funding the deal. So let's say it takes me 5 hours, hell, let's say 10 hours, right?
mm.
But the return on the back end, the amount for like the dollar per my time is
Oh yeah.
significantly higher. So it is allowed me to accelerate like where I'm spending my time and where my money is going for my time. And so, I do one lump sum at the end of 6 months just because I don't need the money right now. If I didn't
Mm,
have a W-2, then I would probably structure that monthly interest payments. But I have that W-2, so I could be a little bit more flexible and ask for a higher return because of that, and that works for me. And so it's been really, really great for the returns on the money. What I do is I get the principal and the interest paid out at 6 months, and let's say I gave or I lent 100K and then I got 15K back. I'll just take that 115 and put it right back into the next
mm.
deal, so it's compounding, right?
Back.
And so it's been really amazing. I've sold quite a few Amazon shares because of it, because I can get a higher return and I use my self-directed IRA. So I've done a lot of different things to really lean into the world of lending.
That is so awesome. Yeah, and you mentioned time, right? How much it takes you as far as the underwriting process. And it does take time to build that craft, right? So it's not going to happen overnight. So definitely take your time if you're looking to become a private money lender. Connect with Casey, connect with myself, ask questions, ask. And you know, if you spend 3 to 4, maybe 8 hours, right, underwriting a deal, or
Yeah.
it's still right. The time you spend on the deal, you mentioned it, right? It's yeah, night and day compared to managing. Although you don't get all the nice benefits of big appreciation properties, right? But still, it's still right. If something passive where you are making money, and I love the way you structure yours, right? To your loans to fit you, right, as the investor.
Yeah.
A lot of investors potentially would say, hey, no, I need monthly interest, right? Just to make sure that the investor is enticed into the deal, right? Because
Mhm.
and others are like you, right? Hey, no, I'm okay. Let's just wait till the end of 6 months or 3 or 4 months, whatever that time frame is, and then
Mhm.
you balloon me out with the interest plus the principal. So I love the structure, and it's great to be able to have that different, right? Different type of flavors to when it comes to investors.
Exactly. And I think that's kind of like the very fun part of lending is if you do need the monthly returns, that's an option that you can negotiate with your borrower, right? I don't need that at this point in my life. And so I probably will, I hopefully will in the next, few years of leaving my W-2, right? But there's so many options in how you can structure it and how like you have the term, the hold period, you have
Hmm.
the interest, whether it's flat or annualized, you have payment, if you want monthly payments or just lump sum at the end. Like there's just so many ways to play with it to make it a win-win for both parties that, you can get kind of crafty and creative with it.
Yeah, absolutely. That's so
Yeah.
true. And it has to fit your lend box. Casey mentioned that earlier, the lend box. If you are becoming a private money lender, definitely hone in on that lend box, right? What is
Yeah.
your risk factor? How do you want your payments to be paid out, right? Is it going to be monthly payments? What type of interest makes sense too, right? Because some interest potentially could break a deal, or there's not enough margins in there. Casey mentioned numbers earlier. So that's where it's so important, because it does have to be a win-win at the end, right? Hey, the investor, the fix and flipper, or buy and hold investor, they need to make profit, and then you need to make your profit.
Yeah, exactly. That's a good point. I feel like it has to be a win-win. Otherwise, while you might make a lovely return, your borrower might not want to work with you again. So
Right.
make sure it's structured. You got to make sure it's structured quite well.
Awesome. Well, Casey, you got any other projects going on besides lending? Are you looking at acquire any other Airbnbs, or you are done with Airbnbs?
I think I'm done with Airbnbs at this point. I will say the tax benefits have been amazing, so I'm
Mm,
very thankful for those. I'm actually looking right now to 1031 my Airbnbs into long-term rentals.
let's
Because,
go.
yeah, so I'm excited to see where that goes. And then I'd also like to scale my long-term rental portfolio. The one that I have a property manager for, and it has been, fairly hands-off, and it's been a
Mm,
really great experience. So I'd love to build out that, more passive, or I should say, additional passive income
sure.
for myself. And then you get the tax benefits too of owning real estate.
Yeah, that is true.
Yeah.
Well, Casey, I'm so grateful for you taking
Yeah.
time and we had this amazing conversation about private money lending. Thanks for sharing your takeaways, or your lessons, hard-earned lessons.
Yeah.
So, if you can leave us with one more hard lesson for the day and just say, "Don't be a knucklehead, don't do this." What would Casey do? What would
Ooh.
Casey say?
I don't know if I have anything new. I feel like it's just like learn how to underwrite and get really good at that. I think,
Mm,
you can always underwrite with like other people's deals as well. So like if you are able to connect and with like Edgar or myself and be like, "Hey, let me see other deals that you have funded, why you funded or why you haven't." I think that's so valuable just to get that muscle working, right? Of underwriting. And that way when it's time to fund your own deals, it's you're ready to rock and roll. So I think just working that muscle as much as possible and really learning the math behind it will really help you not be a knucklehead like I was.
like I was too.
We're all knuckleheads. Hopefully, other people can learn from us.
So yeah, learn from us, please. So
Yes.
I love that takeaway, Casey. Learn that underwriting process. Understand the numbers. Numbers don't lie in this business. So again, Casey, thanks for taking time. And where can people connect with you, Casey?
Yeah. So I'm on Instagram at Casey Hilders Invest. So feel free to connect with me there, and I'll be happy to chit chat.
Awesome. Well, we'll definitely stay connected, see
Yes.
or continue our journey, and we'll be chatting with you later on, Casey. Thanks again, and
Thank
connect
you.
connect with Casey at Instagram, y'all. Talk to y'all later. Peace
Bye.
out. Bye.